Welcome, everyone, to the Nichols Redpath Tax Update Podcast, issue 2239 for September 26th, 2022. Just as an aside, for those of you that are interested in updates on professional ethics, Ian joins me on Thursday this week in the afternoon to talk about professional ethics, the AICPA rules, the Treasury rules, the Internal Revenue Code rules, and some common sense. But today, our mission is reports for the week. What caught my attention this week? Ian's been busy with the grandson. He's got some unique circumstances, but he'll be joining us as we go through these coming weeks. First, how do you claim an alternative fuel credit? Then this limited partner issue keeps coming up. The only word I can pick for is kerfuffle, which expresses the situation in a upset between a legitimate limited partnership with limited partners and the Internal Revenue Service trying to impose a definition that simply doesn't exist. Next, organization loses its 501c3 status for facilitating tax shelters. That's going to happen anytime you lose your way with a 501c3. And then we have 3 501c7s that lose their tax-exempt status because they lose track of their non-member income and/or they make their facilities available to the general public. 501c7 is a organization for a group of like-minded individuals who want to share their time and interests for shooting at targets or making jewelry or doing stuff that they like to do together. That's what a 501c7 is for. It's not for running an amusement park for the general public, for an example. Finally, I want to remind everyone that improperly forgiven PPP loans must be reported as income. And we're going to talk about the 2 tests that you have to apply to disbursements of money that you got from a PPP loan to determine whether or not you keep the money or have to give it back, or if you keep the money, have to report taxable income. Well, that's enough for a good beginning. Here's the Alternative Fuel Tax Credit Notice 2022-39. If you want to claim the alternative fuel tax credit for sales and purchases made in 2022 and may have filed an anticipatory claim, you fall under this guidance and your anticipatory claim must be refiled. That's the big news. There were those who said, well, just go ahead and file your claim in anticipation of the rules changing and you'll be picked up when the rules change. Not so. You have to refile your claim. Then you have to claim this one-time alternative fuel credit for 2022 by April the 11th of 2023. No claims after that date will be processed. Here's what the Form 8849 looks like in case you haven't seen one. It's a claim for refund of excise taxes. And all the way down at the bottom here, Schedule 3 is the most important part of this, reporting the sales or purchases of fuel mixtures and the alternative and claiming the alternative fuel credit. What controls a classification as a limited partner? It would be easy to say that Code Section 1402A13 controls that classification. It says that income attributable to a limited partner as such is not subject to self-employment tax. That a guaranteed payment made to a limited partner for services rendered to the partnership will be subject to self-employment tax. But simply allocating income to the limited partner, who in that allocation is not being made to compensate the limited partner for services rendered to the partnership, there can be no self-employment tax imposed on that income. This is a belief strongly held, obviously, by taxpayers, and the IRS holds the opposite, but they haven't been able to get anything done as far as rock solid guidance. It just hasn't happened. what you've got is the code section, but it doesn't go on to define what self-employment income or what self-employment activities are. In Sorobon Capital Partners, we get a little window into how litigation is going to go. Delaware law is the state law at issue here. The income in question is $63,866,301. This is the income of Sorobon Capital Partners. 3 individuals were limited partners in that partnership under Delaware law. The tax matters partner was Sorobon Capital Partners GP LLC. Modest guaranteed payments were made to limited partners for their services. The 3 limited partners together received guaranteed payments of about $1 million. One limited partner had a guaranteed payment of about $600,000, and the other 2 limited partners had guaranteed payments between $200 and $2.25 and $3.25. So it appears they were fairly compensated for their work. The other income was not directly related to services performed by these limited partners. They did not participate in the management of the partnership. They didn't help make the decisions. They were simply investors, and the partnership was run by another partnership, Sorobon Capital Partners GP LLC, which was owned, at least in part, by some of these limited partners. But are you going to respect the legal status of these individuals and of this entity under Delaware law or not? The IRS says not. We're going to ignore Delaware law, and we're going to take the position that these men are, that their income, $63 million, is subject to self-employment tax. Wow. This is going to be interesting as this plays out, because the Congress has just forbade the IRS to issue regulations here, and that was 20 years ago, maybe 30 years ago. And we've been arguing about who is a limited partner ever since. How do you lose 501c3 tax-exempt organization status? Well, if you allow your organization to be subverted to assist in the promotion of a tax shelter, it's pretty easy. 501c3 allows tax-free organization and operation. You organize and operate exclusively for charitable, educational, and certain other purposes that are listed in the statute. This organization, the one that we have under the microscope, operated at least in part to facilitate an S corporation tax shelter scheme. And they allowed the organization's net earnings to inure to the benefit of private shareholders. There was a scheme that at least part of the income from a promoted deal would stay in the 501c3 charity in this case, but the bulk of the income would go to the promoter who facilitated the entity participating in this tax shelter, which required the presence of an S corporation and a 501c3 tax-exempt entity to work. The IRS said allowing the S corporation shelter to avail itself of your tax-exempt status for the purpose of a tax shelter is enough to kill your tax-exempt status. On that subject, we have 3 social clubs here who lose their 501c7 status. That's the tax-exempt status for a group of people that like to do stuff together. Their tax-exempt status. So a tax-exempt social club, first of all, has to be organized and then operated under certain rules. No more than 15% of revenue from non-member activities. Facilities cannot be open to the public, and the entity must avoid unrelated business income. Any amount over $1,000 of unrelated business income will be taxable, and too much unrelated business taxable income will cause loss or lead to loss of status. Here are the organizations. These are private letter rulings given to these 3 organizations on their way out the door. The 13 non-member income was more than 15% of total income, and it was not operated exclusively for pleasure, recreation, or social purposes of these members. The 15 letter non-member income exceeded 15% of total income, not organized and operated exclusively for non-profitable purposes. Well, wait a minute, this gets to be a familiar theme. What about the 16 letter? Non-member income greater than 15%. Well, okay, there's the trigger, gang. When non-member income exceeds 15% of total income, the organization is going to lose its tax-exempt status. 501c7 is going to lose its tax-exempt status. Now there's a 35% test. Let's go down the line here. Let's get the 16 ruling. Non-member income exceeded 15% of total income, and their facilities were open to the general public. Now let's go on. The total non-member income, including investment income, was more than 35% of total receipts, and their tax-exempt status is gone for sure. You didn't have to worry about the 15%. The 15% is part of the 35% here. But any CPA that's in public practice is likely to run into a tax-exempt organization that needs their help to file, to make sure that they're in complying with the Internal Revenue laws. And you need to know that losing your tax-exempt status is pretty easy when you begin to accept non-member income, or you get involved in activities other than the activities for which you were granted tax-exempt status. Finally, this week, I'll talk a little bit about PPP loans. Everybody that was in business got a PPP loan. My client that's a motorcycle shop got a $40,000 PPP loan, and they used that to make payroll and to pay rent and to buy parts that they needed to fix motorcycles. So, is the loan now forgivable? Well, there are 2 tests, and that's where a lot of folks kind of, I think, miss the boat. You got the expenditure of PP loan proceeds has to meet 2 tests. First, those payments, those expenditures must be deductible for federal income tax purposes. If you miss that, then it doesn't matter that the expenditure met any other test. If the payment, for instance, if you made a payment on the principal balance of a mortgage, that amount cannot be part of the PPP loan forgiveness. So it's got to be deductible. Then it may only be an allowable PPP expenditure. And those expenditures could be summarized pretty quickly by just saying the money you have to spend to stay open, to stay in business. At least 60% must be used for payroll. After you have used at least 60%, and you could use the entire amount for payroll, that would be okay. But you have to use at least 60% for payroll. After that, the 40% may only be used for specific operating expenses, the things you have to pay to stay open, to stay in business: rent, supplies, utilities, operating delivery vehicles, interest on business loans, the interest only, not the principal payments, the interest only, the expenses. Remember, test number 1, it's got to be deductible for federal income tax purposes. Well, it's a great week. I always enjoy these short visits. I look forward to welcoming Ian to this short program in the coming weeks. But by the way, we are together on Thursday afternoon talking about professional ethics as they apply to a certified public accountant. Please join us.